Sharon? Or...
No, you just leave it like that.
Hi, my name is James Longstreet. I'm the president of Fivefold Wealth Management. I'd like to thank you for joining us today on this webinar with Centurion REIT, which is the largest private real estate investment trust in Canada. For those of you on the webinar today that are currently investors with Centurion, this will be a great update for you, and also an opportunity to hear directly from both Matt Barnes and Steve Stewart with Centurion. And for those of you on the webinar that are not currently invested with Centurion, you will learn about Centurion, and it'll help you to determine if Centurion may possibly be a solution that will fit into your overall financial plan. And on the webinar today, we're going to keep the presentation to approximately 45 minutes max. Then we're going to address all of your questions. So during the course of the presentation, if you'd like to type in your questions in the Q&A, we will make sure to address those in the last 15 to 20 minutes. And also joining us today on the webinar is my great friend and colleague Bill Westmacott out of Chilliwack, BC with Fivefold Financial. Bill's joining us today with some of his clients as well. And from Centurion, we have Matt Barnes and Steve Stewart joining us from Toronto. Matt Barnes, I've been working with Matt for approaching 10 years now. And Matt is the director of sales, and Matt has been with Centurion since June of 2014, just under 10 years. And Steve Stewart, Steve has over 25 years of experience in the financial services and investment industries. Steve is the vice president of mortgage investments and joint ventures with Centurion. And Steve started working with Centurion just over 10 years ago in 2013. So both Matt and Steve have approximately 10 years of experience working with Centurion. Matt just under, Steve just over 10 years. And in just under the last 10 years, Centurion has grown by over 10 times in assets under management. In June of 2014, Centurion had approximately $600 million in assets under management. And as of today, March of 2024, Centurion now has over $7.2 billion in assets under management. They own 157 buildings and over 22,000 units across Canada. So first, Matt Barnes is going to share with us approximately a 15-minute presentation. And then after that, Bill, and Matt and myself, we're going to have an in-depth discussion with Steve Stewart. And then again, during the last 15 to 20 minutes, we will address all of your questions that, again, you can type into the Q&A box. So with that, yeah, Matt, Steve, thanks for joining us today. How are things in Toronto?
Fantastic.
Things are great.
Are the Leafs going to make it to the playoffs? Just asking.
I
have no clue.
Yeah.
Yeah. So, yeah, thanks again, Matt and Steve, for joining us. Matt, why don't you just take it away? The floor is yours. And yeah, all yours, Matt.
Sounds good. Thank you, James. Great to see you again. Good to see you again, Bill. And James mentioned I've been at Centurion for just under 10 years. My 10-year anniversary is coming up in June. We've seen some exceptional returns, and I'll just say really due to the outstanding management and structure of Centurion. Before we get into the details, just a quick review of the disclaimer here. This has obviously been prepared by us, and this is for information purposes only. And if you look to invest in the fund, as always, talk to James, talk to Bill, your advisors, to make sure that this is suitable. There's always going to be some risks with any type of investment. We've got a great long-term track record, but as you can see there, past performance may not be repeated. But I always do stress again, talk to James, talk to Bill to make sure that this is a suitable investment for you before you proceed. With that, really quick background on Centurion here. The fund was launched by Greg Roman. And really quickly on Greg's background, he was a former derivatives trader, had a tremendous 10-year plus career, worked in Toronto, New York, London, Hong Kong, Singapore, financial capitals around the world. And as a derivatives trader, he was restricted on what he could invest in. So his focus was on investing in real estate. He has some real estate assets kind of spread around the world. So after his 10-year career, We ended up getting last in Singapore. He moved the family back to Canada and focused on building out his own portfolio in 2000, 2003. He launched Centurion itself, incorporated Centurion. 2006, he launched LP product for friends and family. And then in August of 09, those LP assets rolled over the apartment REIT we have today. And about 55 million in assets rolled over. And as you can see, we've had some strong growth. And the firm itself, I think it was launched with, it was Greg Rowan, our president and founder, and about 5 other people. We've grown considerably over that time frame. And I do stress, the growth we've seen has always been done the right way, always with a long-term focus, always building value for investors. And really the mindset is protect investors' capital first and foremost, give you some income, and give you some appreciation on top of that. And I think you can see from this chart here that Greg and the investment team have done a great job of doing that over the years. I like to say it's a nice, boring fund. You don't get any of the excitement of the public markets, and it's really great to be in multi-residential in Canada with the focus that we've built over time. And I'll say this, our target return is 7 to 12%. Income plus appreciation, so it's a total return of 7 to 12%. We've really hit that almost every year, and last year was a low year for us. It was 6.5%. Right now, year to date, after 2 months, we're on track at 1.6%. So things are definitely looking better. And I would say last year was likely a low point, which in an investment is not the worst thing in the world whatsoever. So things are looking very attractive for the years ahead. You can always say our target return is 7 to 12. But things are very positive what we see going forward. I want to talk about what's positive. There's a couple of things. One, first and foremost, is the supply-demand imbalance here in Canada. I think we're all aware we've seen the very strong population growth that this country is seeing. It's been over 1 million in 2022, same in over 1 million in 2023, and we're very much on track to do the same here in 2024. So if you look at the first bullet, I guess the first line there, this is from 2022, and we were at 18.5 million housing units in Canada. We were going to build another 2.5 million. CMHC and the federal government realized we had to build another 3.5 million on top of that. So on top of that 2.5 million, we needed to build another 3.5. 2022 to 2030. Can't say there's too many guarantees in this business, but I think it's unlikely for us to build that extra housing that we need. In fact, over the last 2 years, we've seen housing starts decrease. So exactly when we need an increase in supply, we're seeing less supply come online. And they'll touch on Ontario, my home base here. Over the next 10 years, we need to build 1.5 million homes. I think likely we'll get maybe halfway there. On the rental unit side, we'll probably get less than half of what we need supply-wise. Again, demand is increasing year after year while supply is slowing down. Steve will really go over this more in depth, but the high cost of building, high cost of debt makes it tougher and tougher. And I do look at the third point there, and combine Quebec, BC, and Ontario. We'll have to build 3.5 million homes. Forget the rest of the country. We'll have to build 3.5 million homes. Labor constraints. Never mind all the other issues that we're facing. The labor constraints means we'll likely in the best case scenario get to 50%, maybe 30%. So I highlight this just because there was a real issue with building out supply here in Canada. As we've seen demand increase year after year, we're going to be undersupplied. I think it's going to be a chronic issue for the foreseeable future. And what does that mean? Again, on top of the demand that's increasing year after year, this is the vacancy rate here in Canada. And actually, the most updated number we have from the CMHC is the CMHC data, Canadian Mortgage Housing Corporation. Actually, the vacancy rate in Canada for multi-residential is 1.5%. So it's actually even lower than the 1.9 you see there, which was multi-decade lows. So again, I think it really is highlighted with the situation that we're facing here in Canada. It is actually an issue that is going to be tough to solve anytime soon. And you can see here kind of year-over-year increase in rents. The dark blue is the month-on-month, but the year-on-year, all double digits. So you go from some studios, 1 up to 3 bedroom. We're seeing demand push rents higher. And I'll say from our perspective, we're obviously seeing very high very high occupancy rates in our buildings. And our stabilized portion of the portfolio, we're at about 98.5%. And again, really demand is increasing. And we see waiting lists in some of our buildings. So from our perspective, we see that demand pushing rents higher. On turnover in some of our buildings, we've been there for a couple of years. We're seeing rents increase by 20+%. So I do look at this as the demand issue is real. And I think Centurion itself is extremely well positioned to provide much needed housing, but also at the same time provide a high quality investment for yourselves on the call today. we do talk about the issues of building. We forget that nothing is cheaper these days, and you can see over here on the right hand side that high cost of inputs into the buildings have increased by 50% since 2020. Concrete and steel, big inputs into all these type of buildings. Never mind the high cost of labor that's going into all of these buildings. Again, skilled labor in Canada is at a real shortage. I think we have 70,000 vacancies that need to be filled. So again, it's not an easy solution to turn on someone. You have to go through an extensive education period to get to the position where they can actually work on these high-rise projects out there. So again, it's going to be a long-term issue. There's no quick fix for this. And now, this is a breakdown of the Centurion apartment portfolio. And I'll look at it this way. In Ontario and BC, we're in primary and secondary cities. So say in Ontario, that means we're in the suburbs of Toronto and then southwestern Ontario, then up in the Ottawa area. But I do stress, and the same thing in BC. We're not downtown BC, or sorry, not downtown Vancouver. We're in the suburbs, so we're, as you can see, Surrey, Langford on the island, Victoria on the island, up in Kelowna, up in Burnaby. Very purposeful. Because Vancouver, obviously, and Toronto, very expensive. That's not our market. I live in a condo downtown Toronto. I see the rents. I'm glad I bought. You see the rents here. One bedroom is small. One bedroom is $2,500 or more. You want to live in a nice one bedroom or luxury one bedroom, you're paying $3,600, $3,800 for a one bedroom for that. So price points are very different. That's not our market. We saw volatility, especially during COVID, and what people were willing to pay. We're focused really on those far more resilient suburbs. Everyone moves in the downtown core, where it's far more affordable for far more people. And again, that's reflected in the very high occupancy rates that we have in the portfolio. And this situation is same really for us across the country. We want to be where people are moving to, where people are going to live. And so across the rest of the country, we're only in the primary cities. Obviously, Alberta just being Edmonton, Calgary, Saskatchewan, provincial capital, and Regina, Winnipeg, and Manitoba, and even Quebec, the largest rental market in Canada, primarily in Montreal, in and around the suburbs of Montreal. We do have some buildings up in the Quebec City area, but again, it is really more focused on Montreal. And then we do have actually 2 buildings now out in Dartmouth, Nova Scotia, which is really the suburb of Halifax. I just want to highlight the focus is be in those areas that people are moving to, but offer middle income type of housing for people. And that is a very resilient asset class, especially the high cost of housing. A lot of people can't afford to buy. They have to go into the rental market. And a lot more people are going to be faced with that situation going forward. And this just gives you a quick breakdown of the portfolio. And 82% apartment buildings, 10% is on the student housing side. Student housing is a great asset for us. They're 99.5% occupied. Medical offices, that was an exceptional value opportunity play for us. It was from obviously we bought it from someone who I don't think was really necessarily operating as well as they could. So we were able to take that over. The big difference with medical offices versus student housing and multi-residential is we have a third-party equity partner in that runs the day-to-day. We know how to run apartment buildings. We know how to run student housing. We wanted someone who's relatively an expert in running the medical offices for us. So we do have that equity partner in there to do the day-to-day. And we have the 6.2% of the portfolio that Steve Stewart's responsible for. He'll definitely give us more insights into lending and the market that he sees. But really look at this as it is a hard asset. I mean, it's been a great play for inflation, and it is really multi-residential in Canada. I like to say a very nice, very boring asset class with none of the market volatility, but really with some tremendous upside. And these next 2 slides will just give you examples of the type of buildings that we've been buying. And it is middle income type of properties, where this computer generated picture shows you it looks like it's a nice looking condo-like type of building with some nice amenities, in-suite laundry, fitness center, amenity lounge, rooftop terrace, guest suite. But again, people are looking for. I'll say the type of tenant we're seeing are more highly qualified than we would have seen in the past. And by that I mean with higher levels of income, higher credit scores, and I think it's really a reflection of the fact that one, the demand for housing is extremely high, but it's extremely hard to get into home ownership in this country. I look at it from where I sit here in Toronto. I mean, we have to pay for a very small 1-bedroom condo is expensive. We have to pay for a bungalow. $1 million doesn't get you very far in a lot of places. So a lot of people are going into the rental market or they're forced into being renters for longer than they expected. But again, we want to provide that type of housing, high quality, well run, with amenities that our tenants are looking for. And here's just one of the great acquisitions we made in Kelowna. they'll get a nice low rise. We like Kelowna quite a bit, a nice part of the country for us. And again, really a target on middle income type of tenants, and with the amenities that you're looking for. And it's as well, you see we go from studio up to kind of 3-bedroom units. I mean, that kind of shows you we're seeing more demand for those larger units. I see this, people are, if you will, growing up and having families in high-rise buildings, in multi-residential. So there's a demand for those larger units. And this is actually just a great example of the student housing. Again, it's 10% of the portfolio. We love it as an asset class. And this is our newest acquisition. I'll say it's an anomaly in the fact that it is right downtown Toronto, very close to like Ryerson now, Metropolitan University. We wouldn't be buying apartments in that area, but for student housing, we're almost right on. I think effectively we are on campus. It's part of a larger, with more student amenities in that development than just the housing. So we won't be there apartment-wise, but for student housing, we're on campus. And other than that, all of our student housing is extremely close to campus or on campus, which again is reflected in that 99.5% occupancy rate that we see. Really, I'll wrap things up here, and just from the investor's perspective, an attractive tax-efficient monthly income. You have about 4% cash and about 4.2% on the DRIP feature. Obviously, we look at protecting investor capital, giving you that income, and then driving the value of those buildings going forward. And our since inception annualized return has been 12.75%. Again, a very attractive option for investors. You want to get into multi-residential with none of the headaches. No one's calling you to fix a person. We'll take care of that. You're not chasing down rents. I think it's great, as close as you can get to actually hands-on ownership in apartments and rentals with zero headaches. We obviously take care of all the issues there for you. And with that, I'll hand it back to James and Bill.
Thanks, Matt, for that great overview. Appreciate that. So yeah, now what we're going to do, we'll have an in-depth discussion here with Steve and Matt. What we'll do is we'll also during some of the questions refer to some specific slides. So if we can look at that as well. So Steve, first, Steve, again, you've 25 years of experience in the financial services and investment industries. Vice President of Mortgage Investments and Joint Ventures with Centurion. Steve, can you start by sharing with us a little bit more about your background, and also tell us about what your experience has been like with Centurion for over 10 years now?
Sure. Thanks, James and Bill, for inviting me on to join your webinar today. Really appreciate it. I came up through banking before I joined Centurion, so my last roles were CFO of ING Direct. And then prior to that, still with ING Direct, I was the chief lending officer. So I was running their $20 billion mortgage book, although it was more of a residential book, but had some commercial components to it as well. And then along the way, I also spent 5 years with a U.S. firm working on distressed debt portfolios. So, I've had my hands rolled up working out numerous problem files, and feel very comfortable anytime that we have a blip and we have to work with clients to resolve issues. I'm very comfortable in that space as well. Working with Centurion, I guess I should update my bio a little bit. I just crested 11 years with them. We've gone from 300 million in assets when I joined to, as Matt says, 7.2 billion. So it's rare, I think, that you have an opportunity to see that kind of growth coupled with the very strong returns that we've seen over that period of time. So really, it's been fantastic, and I'm not only an employee but an investor here, and very happy with my investments.
Awesome. Thanks, Steve, for sharing that background. So, Bill, do you want to jump in with question for?
Great. Yeah. So, Steve, thanks again for taking your time today. We really appreciate it. So let's kind of maybe talk a bit about macro for Canada, housing and interest rates. We know from the October 2023 article that there's about 3.4 million Canadians who need to renew their mortgages, and over the next 18 months, basically to 2025. So there's a huge number of Canadians having to renew mortgages. And we know that the Bank of Canada, which they held steady today, but anyway, they've hinted that they're going to cut interest rates. And so, Steve, where do you believe the Bank of Canada is going to, what are they going to do with interest rate decisions for the rest of 2024? And then how do you see it will impact Canadians who have to renew their mortgages over the next 12 to 18 months?
Yeah. Yeah, so I listened to the Bank of Canada's announcement today as well. No surprise, they held steady.
Yeah.
They were a little more hawkish and less directive in terms of, when they expect to cut rates and by how much. So I think in Canada, inflation has come down nicely from 8% where it peaked down to just a little under 3 now, 2.9, with the core rate sitting a little higher than that. But it seems sort of stubborn at this level of, in the 3% range. And so while we're still expecting short-term rates to come down and, Bank of Canada rate and prime rates to come down, and that'll help things a lot, perhaps not as quickly or as aggressively as we were thinking a few months back. The U.S., the economy is still doing very well there. It'd be difficult for Canada to decouple significantly from the U.S. without seeing big currency swings. So, that's another pressure on Canada in terms of, not leading the U.S. by very far, not getting too far offside with what the U.S. is doing. And with the economy chugging along there, again, they've been announcing that they're going to cut rates, but again, with the strength of the economy, it may be a little more benign in terms of rate cuts than we've been anticipating. So, what does that do to people? The problem with managing the inflation level through interest rates is that it doesn't affect everyone evenly. It affects certain people quite a bit more significantly. And I would say, in particular, that's young people with large mortgages. And I look around my neighborhood, my middle class or upper middle class neighborhood. Young couples, I've sort of thought, wow, how did you afford to buy here in the first place? But now, 3 kids, maybe a spouse not working, staying at home, facing, rates going from 2% or 1.8%, to 6% or something like that. It is painful. So I've been wondering when the for sale signs are going to start showing up in my neighborhood and elsewhere across the country. I haven't seen it extensively yet, and I think that will there be forced sales? Well, people still have equity in their homes. So you don't need to wait for the bank to tell you to sell. You can choose to sell yourself if you can't make the payments. So, unfortunately, we may see more of that in the future. Housing prices have come off a little bit, not very much. They're ticking back up a bit in some markets here in Toronto. And so, it sort of remains to be seen. But hasn't been, there's been pain, but, and becoming more widespread, but it hasn't translated into, the defaults that you might normally expect. So we'll just see how it plays out.
I actually just read yesterday that they are starting to see delinquencies starting to rise in BC and Ontario.
I saw that
wonder
too.
why.
Yeah. Credit card delinquencies and mortgage payment delinquencies.
And mortgage,
Yeah.
There is stress starting to manifest for sure.
Right.
Yeah. Yeah, I read that article as well, Bill. I saw that. So Steve, thanks. Thanks for that insight. And so now let's take that and look at Matt. If you can you go to slide number 5, Matt, the supply demand slide for Canada. So I guess the question here, Steve, is tell us about what do you see as the the pipeline. What does the pipeline look like for Canada, the current pipeline for new apartment building starts and also just new housing starts overall? And that's the first part of the question. And second part of the question after you address that is just tell us about the pipeline that you see with Centurion for new acquisitions for the next 12 months for the foreseeable future.
Yeah, so my specific area of responsibility in the company is managing our mortgage book and our joint venture book. And as Matt alluded to, it's a relatively small part of the book. His figure was 6.2% of the overall asset base. So, we're not betting the farm on developments, but we do like the fact that we, through the programs that I run, we're able to, through one lens, one way of looking at what I do is that we partner with developers and then deliver a new product to ourselves at cost rather than going and buying it at market value. A portion of it at cost. The portion that we, if we're 50% partner with someone, then we're buying a 50% interest in finished products at, call it, a modified cost level, and that's very attractive to us. In terms of the activity levels out there, I mean, there are still housing starts, and they haven't gone off a cliff completely, but they are way down from what they usually run at, and they're normally fairly stable. So, whereas they run at 225 to 250,000 a year typically, I think we're running a little below 200 now. The starts really switched over from being mainly composed of single family to being mainly composed of multifamily, and that includes condos as well as apartments. So that switch we've seen sort of migrate over the last 10 years or so. There have been a few condo launches over the last year or so, and and some success with condos have to be pre-sold. So some projects have launched. So pretty cautious about that.
Yeah.
Some of those projects that might have been developed as condos, people are talking about building them now as apartments. Costs have risen quite dramatically in the space in general for apartments and condos. And so a lot of people are a little gun shy and sitting on their hands. So that really explains the shallowness in the starts. There are a number of completions coming that will hit the market and will help to propel new supply and give people opportunities, new opportunities to find apartments. But it's nowhere near enough, as Matt was saying, to satiate the pent up demand. Similarly on single family, it's slow as well. We're seeing some suburban projects and some projects further out that are moving along, but again, the demand with various demand drivers coupled with one of the demand drivers, immigration, is keeping prices extremely high. So we're in I think Centurion and my group particularly, we're sort of in an enviable position of having a front row seat to monitoring what opportunities developers are bringing to market. And we don't even if new supply is a little shallow, we don't need to do them all. We couldn't possibly do them all. We just need to get a small percentage of what's coming to market to be very successful with my program, and we're still seeing that. So today, over the last 10 years, now our strategy has morphed a little bit over time, but over the last 10 years, we've delivered about 3,000 units out of our 22,000 units. 3,000 were delivered by our JV programs, and we have another 3,000 that we're working on in the pipeline now. That are, we're not working on them for something in the future. They're under construction and will be delivered and added to our portfolio over the next 1 to 2 to 3 years, depending on when they started. And all of them are going very well, and we're quite pleased with them. Costs have gone up dramatically. So on these projects, we too have been a victim of cost increases in some cases, but rents have also gone up significantly over that period of time. And so I can tell you that we are at least on par, if not expecting to do better than when we started these projects in terms of the return that we expect to make on them. So overall, happy with the portfolio and the way it's performing, and positioned to take advantage of, from a societal point of view, this unfortunate supply-demand imbalance. It's bad for people that want to buy homes. It's bad for people that want to rent, but it's good for us as owners of a large portfolio.
Yeah, and maybe I'll jump into the next. So it's kind of a continuation of the acknowledged massive shortfall in housing units between now and 2030. So we're talking 6 years out. I mean, it more than likely it'll be even beyond 2030. But do you see, Steve, any meaningful programs or things that the government finally is putting in place? I mean, they basically, anyway, I won't get into politics, but anyway, but in essence, I think the government's created this crisis at a provincial, federal, and municipal level. But anyway, but so do you see anything coming into place that's going to actually help companies like yourself from the government that's going to actually meaningfully see larger supply into the market?
Yeah, I'll start from the more concrete and sort of move to the more esoteric. So at the concrete end of things, something that's already been rolled out is the HST rebate on new purpose-built apartments. So, that's quite significant because prior to that, what happened is that when a new project was finished, it was assessed, even if it was retained by the developer. So in our case, these projects that we co-develop through our joint venture, when it's retained by us, we were still assessed a full, federal and provincial HST tax on it at 13%. So the removal of that, drops 13% straight to the bottom line. So that's been quite significant. Now it's a little more subtle than that because the way it was charged depends on unit values and whatnot. But so it actually came in a little less than 13%, but still it's a significant savings.
Was that just in Ontario or is that nationwide?
So federally they dropped it, and then those provinces that have a provincial component, Ontario and BC dropped the provincial component. So it didn't impact Alberta of the provincial component. And then, other provinces are, in different stages of thinking about what how they're gonna respond.
Okay.
But two largest population bases and from the way that our portfolio splits out, our two largest exposures are Ontario and BC. So then, moving on, another significant component of the cost of building these projects is the short-term financing rates for construction financing. So if we see rates coming down, that'll have a direct impact on the costs of projects. So, and I think, those developers that are sitting on the sidelines, it's one of the things that they're waiting for is to see how the rate situation plays out.
Yeah.
The takeout rates are not too far off where they were, a couple of years ago. It's the short-term construction financing rates that are way higher and a lot more expensive than where they were. So we should see some degree of relief on that front. The more sort of esoteric things. So the approval process is slow and pretty horrendous all across the country. And, it can take years to go from if a piece of land needs to be rezoned and then site plan approved and then approved for, development permits, that can be a 3 or even on a more complex project, a 4-year process. And time costs money.
Yeah.
So that's something that, is harder to deal with. It's more entrenched, but there's room for improvement there. That's for sure. I heard something interesting about other jurisdictions where the federal government or whatever, or provincial government or whatever, has wrestled the approval process out of the hands of municipalities and taken it back themselves. And I'm not suggesting that's going to happen in Canada, but some sort of radical solution might be needed in that sort of a vein,
Yeah.
And then the labor situation is quite troubling, really. We have a shortage of labor. We have a significant component of that skilled labor pool that are retiring in the next 5 years.
Yeah.
So we really need to do something, or we're going to have more of a crisis on our hands than we already have. We really need to do something in terms of attracting skilled labor. We attract a lot of immigrants. We've capped that off a little bit. I think I'm a big supporter of immigration, but I don't think it's been prudently managed. And I think a little pause, like the government is taking, is the prudent move. But I think some refocusing in terms of the skill sets of people coming in needs some attention. And then maybe lastly, in terms of back to costs, about over 30% of the cost of new construction is different forms of taxes. They're not always taxes, but taxes, development charges, land transfer taxes, like, all kinds of things. It all adds up to something in the 30% range. And, that's one component of costs. Costs have risen dramatically. Actually, they seem to be stabilizing. And even I read a report out just recently from Altus that they're seeing costs retrenching by, 5%. Now that's on the heels of, 30% increases. So come back 5% is not doing much. But whatever can be done to influence costs, and the government has a say through taxes and near taxes with all of these, different fees that are charged, that could breathe some life into the situation as well. I don't want to sound doom and gloom. I don't think, Matt was throwing out some figures there in terms of 30% or 50% of the problem being solved. I have no idea. But some component of the problem will be solved. And the thing for us and our investors is that, we, as I said earlier, we're in a pole position to capitalize on that and, see some good returns from that.
Well, I know in BC here on Vancouver, the CD Howe did a research on what does it cost a developer in Vancouver?
Yeah.
Just on terms of government costs, it adds between $600,000 to $700,000 to a house, just one individual house. That's how insanely out of control governments are in taking taxation and regulation. It's just crazy.
Yeah, and that's, on a say a $2 million house, that's your 30%. Yep.
Yeah, exactly. So.
Yep.
And the other point that you made, Steve, the process of taking sometimes 3 to 4 years for approval, and you said that has to radically change if we're going to, solve this problem over the next 6 to 10 years or so. Compare that with the U.S., it's approximately, I believe, as little as 12 months or slightly longer. So it's a much longer approval process in Canada, which is adding to the problem, I believe, right? Compared to the U.S.
On the positive side, I mean, you are starting to see some moves in the right direction here in Ontario. Now, I'm not sure if it's still at the discussion stage or if it's actually been enacted, but, as of right, more density along transit routes. And as of right, people are allowed to build laneway houses in their backyard as a, nanny suite sort of thing. So, these things are now, have many of these nanny suites been built? No, something like 50 permits have been issued, which is nothing, in a city like Toronto. But it's all chipping away and pointed in the right direction. I guess the broad picture is, 2 years ago, we used to, like the industry suffered the slings and arrows of being the big bad guys who were, making all this money and, on the backs of consumers and all that. The tone has changed now. The government seems to publicly acknowledge that the only solution to this problem is a private sector solution. And they need to support folks like us in the development industry and the industry that owns these kinds of properties, and make it easier, not more difficult.
Yeah. So further to that, Steve, let's Matt, can you go to slide number 8, please? The decline in the single family housing construction investments. So Steve, you've just spoken to many of the factors that relate to this, the increased costs, construction costs, the financing costs, lack of skilled labor. Really, for this slide here, what do you see this turning around anytime soon, and what other factors you believe would have to be in place in order to turn this around, in order to help contribute to the housing problem that we have over the forecast for the next 6 years plus?
Well, look, sometimes I'm speaking to our purpose-built apartment space, and sometimes these comments are general about housing in the sector in general. But applicable to both of them though, there's a supply-demand imbalance. There's a shortage of housing for the, for the demand that's out there. We have, part of the run-up in the apartment rental rates, and contributing to this supply-demand imbalance in that sector is the fact that houses are so expensive that it's more and more difficult for young people to move out of follow the traditional path in Canada of starting in an apartment, move out into a house. It's harder and harder for them. And I got 4 kids, and they're all still in apartments. Notwithstanding Bank of Dad standing at the ready.
Yeah.
They're all still in apartments. What kinds of things are needed? Well, broadly speaking, we got to correct that supply-demand imbalance. We need more product produced. Maybe we do need to, throttle back on the immigration. I think it's a wonderful thing to be able to welcome newcomers to our country, but it's a little unfair to them, on three fronts, to not be able to provide housing, to not be able to provide adequate medical services, and lastly, and unrelated to this, to not be able to use their skills appropriately in Canada.
Yeah.
Is kind of a travesty.
Yeah.
But I think costs coming down, more stability too. The pandemic, really threw a monkey wrench into the business community's view of the clarity of the future, and then the rates skyrocketing up, on top of that, and there are people sitting on capital to deploy, but they're still nervous about it. So rates coming down to reduce the overall cost of development. The other factors that I talked about, maybe some tax relief, maybe some better financing programs. CMHC has rolled out pretty good programs. Actually, should have mentioned that earlier. The almost everything that I do see proceeding in the purpose-built rental space is with the support of a new CMHC program, the MLI program, which you hardly see any developments, purpose-built apartment developments going forward without capitalizing on that program. It offers cheaper rates, longer amortization. You give up a few things. You got to qualify under a point system for certain design features and or affordability features in terms of offering some affordable units in the mix. But most people seem to be taking advantage of that. So, so CMHC has their ship pointed in the right direction as well, but more could be done there. I'm not expecting a MERB type program from the 70s, but, when you look back through the long history of apartment construction in Canada, today still, most of the stock was constructed in the 70s and the early 80s, and that was specifically because of a tax incentivized program that the government ran, which they killed in the early 80s. That offered, kind of a return on capital to investors. So developers were able to make marginally attractive investments more attractive because of the tax incentives to the investors. I don't hear any talk about anything like that, but there are ways to skin this cat, I think, that need to be discussed.
I think as Ronald Reagan famously said, the government says we can fix the problem. He said, run the other direction. But anyway, we're getting close here on time. So this will be the last question from us. And then we want to actually hear from the audience. There are some questions sitting there. Last one, Steve, we've talked about many things, but is there anything that keeps you up at night? What are some of the biggest concerns you have about our Canadian economy? And just if you could make that one relatively brief.
Yeah, well, a lot of things, beyond the issues that we've talked about in the housing sector, productivity and poor productivity growth and low levels of capital investment and government spending and the government deficits. I know that the government had to step in with radical intervention during the pandemic, but and those things are difficult to manage. But might have gone on too long, and we haven't corrected for it yet. And
it's
we're leaving quite a. I mean, the fact that rates have been low, hasn't pushed up the cost of financing the government deficit excessively. But I worry for my kids. Adding 40 billion a year to the deficit just is not sustainable. So,
yeah.
those are the things that keep me up at night. Beyond the specifics,
Yeah.
more focused on my area.
Yeah, fair statements. Last year was the lowest net capital inflow into Canada since the Great Depression.
Yeah.
When you look at the staggering debts we're covering, which are all inflationary. So you can have the central banks raise rates all day long, but if you have which is supposedly going to lower inflation, but if you have the governments running these massive deficits, extremely inflationary. So anyway, yeah, lots of things to think about these days. So James, do you want to get to?
Yeah, Bill, we're going to address the Q&A. So we have a few questions here. You can, for those of you on the, you can type in more questions if you have more. The first one I'm going to address here is a question from Henry. The question from Henry is what is the current loan to value? And I'll add to that also, Steve, if you can comment on what is the weighted average term to maturity, and what is the weighted average interest rate? So those two, in addition to the question from Henry about the loan to value currently.
Yeah, before I address that though, let's keep in mind here that on this $7.2 billion balance sheet, 400 million is loans and joint ventures, split roughly equally. So 200 million in joint ventures and 200 million in loans. So you're asking a question about 200 million on 7.2 billion. Having said that, happy to answer it though. The loan to value for the first mortgage is 65%-ish. The loan to value for the second mortgages is in the sort of, I think it's in the 85% range. And then we don't really measure the loan to value on the joint venture portion because those are equity positions that we're taking. And so we, they by definition as an equity investment are sort of higher exposure. So that was the loan to value. Duration is around a year, although it's skewed down a little bit by a handful of loans that we have which have already matured. So we show them as 0 remaining term, and would like to get paid out, but we're not taking any drastic action with them just yet. And so that sort of skews the duration down. A more typical duration, like when we put loans on, they range from 2 years to 4 years typically. So call that average 3 years. And then as time marches on, that average is down to a year and a half. So, normalized, let's say, if you take out those zeros, probably around 18 months, something like that. So that was, and rate you asked about as well, James.
Yes.
Rates are, the weighted average rate on the loan book is 10.5 currently, and that reflects a mix of, the firsts and the seconds.
Yeah, sure. So Steve, thanks. Those numbers you gave were for the approximately 6% of the portfolio, which is the loan book.
Yeah.
So appreciate you sharing all that. And I think the question that Henry was asking also is relating to the full $7.2 billion in assets under management. And so Steve or Matt, if you can jump in on this, but I believe the current loan to value on, if we look at the entire portfolio, including the 22,000 approximately apartment units, I believe the loan to value is approximately, and correct me if I'm wrong, around 46%. And then if you can also speak to on what is the weighted average term to maturity? So how long are those mortgages locked in and fixed for? And what is the weighted average interest rate? I believe I have those rough numbers, but
Yeah.
Matt or Steve, if you can comment on those.
Matt, do you have the figures? Speak generally.
The weighted average term is 6.3 years, and the weighted average cost of debt is about 3.16%. So it's And I get you stress, as you mentioned, it is all fixed. All the mortgages now are fixed. So I think did an exceptional job taking advantage of low rates and pushing it and refinancing. So I'll say, a lot of forethought went into that of managing risk, and it really helped protect the portfolio.
Sure, that's what I thought it was, Matt. And is it 46%, Matt, the current loan to value?
Yeah, sorry, it's 46%.
Okay, yeah, that's what I thought. Okay, so 46% loan to value. It's okay, and the 3.16 is the weighted average interest rate, and 6.3
years.
6.3 is the duration. Okay, that should answer that question. So yeah, Bill, if you want to address the second question.
Sure. So either again, Matt or Steve. So this comes from Craig. And again, if there's any other people that would like to ask a question, please put it in the Q&A box. So this question is, who do you partner with in the sorry about that, I'm getting a dry mouth, medical building area? Who do you partner with typically for medical buildings?
There's one group that we've partnered with, and and they're a group that develops and manages medical offices. Incidentally, they also do apartments,
Okay.
but they're probably more of their portfolio is medical office. It's a guy who is a medical doctor who's retired from that and moved over to medical office, investment, and that's a particularly unique skill set. It takes someone who can sort of speak the lingo of the doctors to be effective in dealing with them in getting them to lease space. And the three deals that we've done fall into kind of three different buckets. One was a distressed deal that someone developed and had real trouble filling up. So we, with our medical office partner, purchased that building. I think it was about 30% leased when we bought it. It's now about 90% leased. The second one was a building that's in Toronto, another building in Southern Ontario. It was actually a complex of three buildings right beside a hospital. All three of the buildings were finished. Two of them were fully leased. One of them was 50% leased. So we took it over and filled up the last building. But what the opportunity that we really saw there was for the parking. They didn't have paid parking, and they should have. And they were getting, kind of, I hope none of the vendors are on the call, but they were getting kind of ripped off blind, not having paid parking. So we put in paid parking, and it's worked out quite nicely. And then the last component of that portfolio was a mix of 10 different smaller medical office buildings that we purchased that were in different stages of leasing. We took that over a little over a year ago. It's going according to plan, but the first stage of the plan was removing some of the sort of deadbeat tenants and replacing them with new tenants. So we haven't seen a big uptick in net leasing there, but we've achieved the first part of the plan, which was turning over the poorly performing tenants, and now we're on to filling that space up. So we're actually very, very pleased with how the whole thing is going.
Good.
Fantastic. Thanks, Steve. So next question here from Craig. So the question is, so what is Centurion's focus on new builds or existing properties? So I think just to reframe that question, moving forward, what is Centurion's focus on in terms of new acquisitions? Right, there's the new builds and the new acquisitions, separating those two, but new acquisitions of apartment buildings, and I believe the answer will be on moving forward, assuming, Steve, that the loan portfolio stays around 400 to 500 million. I believe that the likely part of the portfolio that's going to expand is the acquisitions, and even if the 400 to 500 million stays the same as a percentage of the overall AUM, it should shrink. Is that accurate? Can you comment on that?
Yeah, that's what we've seen over time, and so that'll continue to happen. We've sold a few assets, but we're essentially a buy and hold shop. We're trying to buy new. We have, in some cases, to some of our, we're getting some feedback. And Matt, it might be through your,
Yeah, maybe Matt,
speaker.
put
Matt,
yours
if you can
on
mute.
mute.
Matt, if you can mute. There we go.
So we're a buy and hold shop, as I was saying, and so naturally, as we buy and we hold, the portfolio gets larger. On my end of things, if it stays static, it becomes a smaller percentage of the overall portfolio. The things that I'm working on, and the things that I have a counterpart who runs our acquisitions group, and the things that he's looking at buying are similar sorts of opportunities. In fact, one of the things that we like about having my area is that his acquisition area and my development area really complement each other. We know for a fact that we've been successful on some acquisitions where we were not the high bidder, because we're able to offer, going into the future, development partnerships with the parties that we've bought assets from, who had developed them and completed them. So, deals come into the acquisition team and then get shuffled over to me because, they may not have been started yet and the party needs a partner. And deals come in through my area. We may or may not invest in the development. In some cases, we are a little leery about the returns from the development and we take a pass on it, but we've still been introduced to it and we may have an opportunity to look at buying it in the future. So the two areas are very symbiotic and really complement each other.
So of the portfolio, just to maybe clarify, is new builds to buying existing apartments, what would be the percentage, and sort of strategically going forward, just quickly?
It's hard to answer that because we don't sit back and say, okay, we're going to allocate X amount of capital to the joint venture area and X amount to the acquisition area. We're constantly monitoring and we're more opportunistic than that. And if we have development opportunities where we like the risk return parameters and we like the asset obviously, and we're going to own a chunk of it. When it completes, we like the partner and all the metrics. We're very interested in that. But we're not passing up good acquisition opportunities. I suppose to put it in perspective, over those 10 years, we've probably gone back when we were 300 million. I'm guessing we had 600 units, let's say. 1,000 units, let's say. Now we have 22,000. So over that period of time, we've grown from 1,000 or whatever. Let's say it's 2,000. We've grown 20,000 units over that period of time. 3,000 have been delivered through the joint venture programs. Now, having said that, we're a little more heavily into the joint venture programs today than we were because we started lending and then we kind of morphed into lending and joint ventures.
Okay.
Because lending was working well for us. Probably it's fair to say that more activity comes from straight acquisitions than from joint venturing.
Okay. No,
Thanks, Stephen. This will likely be the last question unless we get any other questions here. We're almost at the top of the hour here. So question from Henry, does Centurion perform any financial stress testing? And I'll just elaborate on that second part of the question that I'll add. And Matt, you and I have had this discussion over the years. So Centurion has never been close to a negative rate of return year. Last year, I believe 6.52% was the worst calendar year on record since 2010. So what factors, part B to that question, what factors would have to be in place, Steve, in order for Centurion to have a negative return year? Can you speak to that and the stress testing?
Well, look, we do some stress testing, but we're not privy to sort of sharing all that, or I don't know if I am in this forum. I'm happy to participate, but we're getting beyond my pay grade on that question. But I will say, the return in 2023 was influenced by, we had year over year NOI growth of 11%. Yet our return in 2023 was lower than it was in 2022. And the reason for that is that the return is composed of income and capital appreciation, meaning capital gains on the assets that we own. And, you know, throughout the industry, the way that you value properties changed, and, you know, the multiple basically fell back a little bit. The way that we do it is we use cap rates. For anyone that's sort of in the industry, we use cap rates, and cap rates crept up a little bit. The impact is kind of like the multiple on income declined a little bit. So some of our values came down a bit. Now, in a rising rate environment, you would expect, you know, a fairly strong correlation between these cap rates that you use and the rise in interest rates and the rise in cap rates that you use. We didn't see that. We didn't see that because it's masked. It was masked and continues to be masked by rapidly rising rental rates. And we think that, you know, with this supply-demand imbalance, we'll continue to see those rapidly rising rental rates. And so, you know, we had a little bit of a fair value correction or valuation correction, which put a drag on what otherwise would have been, you know, plus 10% returns like we usually see. So, you know, will that continue to happen? Well, if anything, the opposite will probably be true because, you know, with rising interest rates that we've experienced, cap rates drifted up a little bit. With the expectation that rates are going to fall, cap rates should drift down a little bit. None of these things have perfect linkages, but, you know, directionally, they tend to move together. And so, you know, I think I'm speaking for myself, expecting, you know, better returns going forward. Now, I know I need to be careful about what I say, and what we suggest is 7 to 12% returns, and, you know, expect to continue to fall into that range.
Excellent. Well, yeah, Steve, Matt, thanks so much. We're just past top of the hour here. Yeah, thanks for joining us today. Thanks for the discussion and the presentation, Matt and Steve. Bill, thank you as well. And thanks to all of you who joined us in the webinar today. And yeah, have a great rest of your day. Enjoy the.
Oh, and you may, James, sorry, you may just want to mention, or we want to mention that this is recorded. So for those who want to watch it again, James will post it on his website, and I'll post it on mine for those whoever you're connected with. So you can watch it again or share it with family or friends if it's something that you think they might be interested in.
Yes. Yeah, of course.
Thanks.
Thanks, Bill.
Again. Thanks
Thank
again
you,
for the
guys.
opportunity.
Thanks, everyone. Thank you very much.
Okay, bye-bye.
Okay,
Bye.
bye.